Jill, you're constructive. You like the markets into next year. Does news like this and market reactions that we've seen over the last few days give you pause on your optimistic outlook?
Right. Well, I think, some of the biggest overhangs on the market right now are trade uncertainty, which will certainly have an impact on corporate profits and margins and overall market sentiment if we don't see a resolution sometime in early next year, as we're expecting. We are constructive on equities in the near term, since we think there's still room for improvement in equity sentiment. The fundamental backdrop has still obviously been good. Corporate guidance and earnings have been very strong, and valuations have come down to more reasonable levels. But we do see risk looking out into next year. So we have a 2,900 target on the S&P 500 for year end. But we do see risk that the market peaks sometime next year at around 3,000. And really our highest conviction call is you want a position for more volatility. So we haven't seen, the level of volatility for much of this cycle that we're seeing recently. You haven't seen this amount of 5 or 10% pullbacks. So we think you want a position for higher volatility. And our model is one of the best ways that we've found to forecast volatility is the yield curve, which has been in the news a lot this week, obviously. But the flattening yield curve has a very good lead on the VIX, and that's suggesting the VIX should double between now and 2021.
So where do you want to be in that environment within equities?
Right. So you want to buy high quality stocks and stocks that have very stable earnings. You want to buy companies that are generating cash and avoid credit sensitive stocks, users of cash. It's one of the reasons we prefer large caps over small caps, which typically large caps fare better in higher volatility environments. So those are the areas we think investors should want to focus their portfolios in the coming year.
Keith, this Huawei news, just the latest in terms of concerns after the tariff man comments or tweet from the president. Do you have to stay away from China-related stocks or U.S. businesses that do a lot of activity and revenue growth in China?
Yeah, we'd say that quite a lot's priced into the market, and a big part of that is tariffs and tariff-related stocks. If you think about it, S&P earnings per share will have been up over 23% this year, and the market's flat. So we've had a bear market in the multiple, and one of the key overhangs has been trade risks, and by our estimate, a further escalation scenario would be potentially 7% downside or toward 2550 on the S&P 500. Obviously, we priced that, a big part of that out on Monday, and we've priced a lot of that back in. By our estimates, China-related stocks are pricing about 6 to 10% relative risk or valuation discount on some of these fears, and we see the potential, if and as talks continue and certain agreements are reached, that risk can be priced out.
Keith, Jill mentioned the inversion of the yield curve, or at least the flattening of the yield curve with some inversions there along the way. How big of a worry is that to you? She said it means more volatility, but doesn't necessarily mean get out of stocks. Do you agree?
That's right. We've done some work on the yield curve, and surprisingly, we found that in the past, going back to the 1960s, if you were to have bought the S&P 500 on the day that the yield curve hit 0, 10s, 2s, the average return to the subsequent peak has been 29%. So it's not been all that bad for equities, and obviously later cycle returns, as Jill mentioned, tend to be more volatile, but getting out of equities now could be leaving quite a lot on the table.
Jill, how much of your optimistic forecast, and you do expect it looks like the S&P to reach 3,000 by the first half of next year, is predicated on what the Fed does or does not do?
Well, we are expecting the Fed will continue to hike rates at a measured pace and more than the market is expecting. So my colleagues on the economics team are expecting we see 4 rate hikes next year. So that is our base case assumption. But obviously, if we see a policy mistake by the Fed, that is one way bull markets can sometimes end at the hands of the Fed. So that's what we're baking in. But I think the Fed and trade will be two of the key variables that are big drivers of equities next year.
I mean, 4 rate hikes, Keith, sounds aggressive given this current market volatility and the darkening outlook for the global economy. What can the market handle in terms of more rate hikes?
Yeah, I think we've heard from Chair Powell over the last week, walking back some of the comments about the neutral rate, and I think equity investors and investors in general pricing out some of that risk of over tightening, and we hear comments from other various Fed members of the same. Work we've done suggests that when rates go above the level of nominal growth is when we've gotten a signal for when the economy is starting to turn, and that would be over 3.5%, 4%, and we're still a long ways from that.
So in terms of high quality names, Jill, where do you put technology in there? I mean, that was the growth engine. That's where we saw the earnings growth. It's where a lot of the high quality companies are, but they also stand to lose if this trade war does intensify with news like this of the Huawei CFO and founder's daughter's arrest.
Right. Yeah, it's interesting. Tech is obviously one of the most globally exposed sectors. So tech, industrials, many of these areas will certainly be at risk if we don't see a resolution on trade and see a further escalation of tensions. But from a quality angle, tech looks very good, especially given the sector change. And you've seen some of the high growth, secular growth internet companies come out of tech and move into communication services. So the tech sector right now, which is a lot of older tech companies, more mature tech companies, it actually looks very good from a quality angle. It has very stable earnings. These tech companies are increasing their cash payouts, becoming more attractive to income-oriented investors. It's the cleanest balance sheet sector within the S&P 500, so more cash than debt. So we think we're overweight tech and think the sector could hold up well in this environment, but obviously trade is a risk there.